Good afternoon, everyone. This is Bob Dole from Solution Driven Wealth, and we're recording this on Friday, March 13th, 2020. As everyone is well aware, there has been a great deal of upset in the markets, financial markets, over the last number of weeks due to the coronavirus, its spread, and uncertainty that's spreading into the financial markets and our culture, frankly. So what I wanted to do today is, in times like this, it is our responsibility to communicate with you to our very best ability, remind you of our plan and our strategies that we put in place for many years for many of you, and strategies to somewhat take the emotion out of the markets and again, bring it back to your specific financial plan that we've worked on very diligently for you. So the presentation will begin really to remind you that we are here for you. Me and my staff are here really at all hours to answer any questions that you have, concerns that you have, and it's why we work with you. It's why you hired us, and we are here for you. We will remind you that you have a plan, and in times like this, where you're being bombarded from the media, from various sources of a lot of information, it is good to remind yourself and ground yourself that you do have a sound financial plan that is long-term in nature and will enable you to ride out markets like this. This also will present some opportunities, very unique opportunities in the market that may involve our involvement and may actually involve your involvement in terms of refinancing opportunities, some of which we never could have imagined really you being able to take advantage of. And also, we do want to be mindful that fear is not a plan. Panic is not a plan. Beware and mindful of your emotions. In this type of market, it is not a recipe for success. In fact, it's a recipe for failure and a continued failure if you follow those types of emotions. Lastly, we do want to remind clients that this is a time to review the Secure Act. It is an important element of 2020. It is legislation that was passed late last year. And because the market's behaving in the way they are, it could represent an opportunity to convert a Roth IRA in the right set of circumstances. So having said that, we do want to remind you that knowledge is power. Be an informed investor. Our goal is to make you the most informed investor in your neighborhood, your family, your community, your synagogue or church that you worship at. We want you to be informed with actual statistics and information that you can utilize for your own benefit. We do want to remind you that we also have studied with you the basic 5 key areas of a financial plan. That's preservation planning, retirement planning, tax planning, estate planning, and investment planning. Investment planning is just a component of it. For many of you, we have reminded you to have an emergency fund. Most clients have that, and they're able to take advantage of markets in these types of conditions. So what we also wanted to remind you is that, the markets in the last 10 years since during this bull market, they have not moved in a straight line. And in fact, in one of the best years of recent memory, even in 2019, you can see on this chart, and this is only equities. Keep in mind, most of you have a semblance of other investments in your portfolio, such as fixed income or bonds. This is simply the equity markets as measured by the Standard & Poor's 500 index, that even in times of a great year, such as 2019 for equity markets, there are pockets where you can see some rather significant downturns in the market, even in a great year. And if we go on a 2-year chart, where we go back all the way to 2018, we had a really large downturn. If you recall, in December of that year, that was the year in which the Federal Reserve raised rates 4 times. And after the 4th time and the guidance that they provided, the markets did not like that at all, and the markets turned steeply downward, almost a 20% downward move for the equity markets in a very, very brief period of time. The point that I'm trying to make with these slides is I think many of us and some investors have forgotten that the equity markets by their nature are volatile in nature and do not provide a straight line up towards great returns. Part of the process of being an investor is stomaching some very difficult moments and times during these types of moves. There is no denying that we're in a very unique set of circumstances at this point in time. And I'm going to state the obvious that our economy currently is essentially being quarantined, with many hotels being shut down and many large amusement parks and even professional sports teams and collegiate teams putting regional and final championships on hold with no spectators. So these are unique times. This will clearly have an impact on the economy over the intermediate term, and there is no denying that. There is a ripple effect in the economy, and this will turn down for the next couple of quarters will be challenging. However, that does not mean that you flee to entirely fixed income, and I'll explain why in a few minutes. But again, panic is not a strategy. We've had downturns before. The fundamentals of the economy before this downturn were actually quite strong, and we do believe that going forward, there are elements in the economy that present opportunities. Also, we do want to review that the equity markets were actually good between 2010 essentially and 2020. Certainly early part of this year, the markets hit a new high. But again, if you look at these charts, the market did not move in a straight line. It did take some dips at various times and for various reasons. Volatility. I do think many investors have forgotten there, specifically, what are the magnitudes of some declines? And to put it into perspective, we typically have declines very commonly of 5% 3 times per year. Declines of 10% or more are common once per year. Declines of 15% or more are common once every 2 years. But declines of 20%, well, they happen about once every 3.5 years. And again, we've been counseling clients for many years now that we are 10 years into a bull market, or we're 10 years into a bull market, and that it is only logical that a recession would take place. I don't think any advisor or client would have predicted that the coronavirus would have been the issue that would have potentially put us into a recession, but here is where we are. And I think we have to understand that markets go in waves, and this has happened before. If we look historically for corrections of over 10% since March of 2009, during what we all perceive to be a very good bull market, we have had declines of 20% or more at various times. Sometimes it was because of tariff or trade wars. Other issues were because the Fed was raising rates quite quickly and probably more or not to the liking of the markets. And if you remember, we had the Greek debt crisis back in the early 2010 to 2015 period, where it almost seemed like every couple of years the Greek debt issue was the issue that was going to be the contagion that was going to affect not only just those countries who had low debt quality, but have a ripple effect through the entire Eurozone. What does it mean to invest in these types of economies and in these types of markets? And what is the overall planning approach that you should take? Well, let's talk about this roller coaster, and we're in the middle of one right now. And emotions can certainly play a large role in how people react and manage their portfolios. I think to the client who doesn't have an advisor, the greatest potential risk is when times are great because they pile money in. And then all of a sudden an event hits, and the coronavirus is a great example, and the markets begin to go down. And as they near the bottom, clients begin to unload their portfolios, and then they sit in cash. And then they will sit in cash for a long period of time, typically, and then they will begin to evaluate when markets begin to recover. But in many cases that we've seen in events like this, there can be a V-shaped recovery. And in those types of environments, it's possible for the client to miss those opportunities. Again, we preach a long-term investment strategy, one that is designed to provide income over a long period of time with consistency of returns throughout those periods. This is not a pleasant period. It is a fearful period. And to put it into perspective, there has been really a dislocation in the fixed income markets. It is worth noting that the 10-year Treasury was trading at about 2.5% last year at about this time. Recently, the 10-year Treasury has moved all the way down into the 0.7 to 0.8 range, and the 30-year Treasury remarkably went below 1% for a 30-year yield. That is an incredible statement to make. I'm going to make it again. That means if you bought a 30-year bond last week, you would have been comfortable with a return that would have been under 1% for the duration of those 30 years. That is a tremendous dislocation in pricing, and I think most investors realize that a sub 1% on a bond for 30 years is not a sound investment strategy. So that is why earlier when I said to fly out of stocks and into fixed income, and that is not a strategy, that is the reason. You'd be buying bond prices at all-time high prices, or be buying bonds at all-time high prices. So not something that we generally recommend for the long-term investor. Yeah, so equity markets advanced. Obviously, this is a little bit of old news. Equity markets advanced early this year and then declined rapidly with the onset of the coronavirus. And I really think the uncertainty surrounding containing the coronavirus, the treatment for the coronavirus, has led to some very steep, equity market declines. In many cases, fixed income has done quite well. However, not actually in all cases. Some fixed income has actually struggled in this type of environment remarkably. So a very unsettled time. What do we think will happen as things go down this year? It is undetermined right now. It is hard to imagine that there will not be a ripple effect in our outlook as far as where the equity markets go in the short term or the longer term this year. We definitely feel that with our country essentially being almost on a quarantine type setting, that this will have a ripple effect in the economy. It could lead certainly to a short-term recession. But that does not mean that we should dramatically change a client's investment portfolio. Again, jumping in and out of the market is not a way to make money, in our opinion. Last year, we experienced some uncertainty with trade wars, and that was exacerbated by some downturn in the markets, especially in late 2018, coupled with the Fed's outlook. But at various times, and even in 2019, with the on and off trade war talks and tariff talks, the market had some upset. We are receiving, as I mentioned earlier, or are being impacted by very, very low federal funds rates and also money market rates. And again, I said earlier that the 10-year Treasury hit a much lower rate than this, but according to Yahoo Finance, which we just checked because we actually had to update this slide because it was out of date, hit about 0.81 on the 11th, 2 days ago, before we recorded this. A year ago, that same rate was at 2.59%. This is a key interest rate and again represents an opportunity for our clients, not necessarily with where we can help them, but where they can help themselves. 10-year Treasury notes are really designed and all of our interest rates function around that specific rate. That means mortgage rates, car loans, any personal financing, credit card rates, all revolve around this rate. It is an outstanding time to go back to your mortgage lender or a secondary mortgage lender and renegotiate a rate on your mortgage and or a car loan or what it might be. You'll be able to, in most instances, assuming you have good credit, refinance this to extraordinarily low rates and lock those rates in. That's a permanent savings to your cash flow and represents an excellent opportunity and one that you should take advantage of if the merits of the refinancing make the case. So if you're going to pay a lot of closing costs, be mindful of that. But again, if you can amortize these closing costs over many years, it's a tremendous opportunity for you. Again, I mentioned the 30-year Treasury bond because we do not feel that bonds at this juncture are an outstanding opportunity to invest in. They are a safety measure for sure, but we do not feel that long-term rates will go extraordinarily lower from here. They could certainly go lower, but we do not feel that locking up your money in a 30-year bond at this sort of rate of return is an attractive investment. We do not feel that way. In fact, we feel that dividend-paying stocks offer a much, much better opportunity to invest in. In many cases, high-quality dividend-paying stocks for the right investor represents an excellent opportunity. Many of these stocks have yields between 2 and 4%, so almost double the dividend yield on the 30-year Treasury bond, and to us, an extraordinary opportunity for the investor to improve their rate of return. So something to be mindful of. Again, the other thing that we wanted to make you aware of is the media is not your advisor. It is also does not represent your portfolio. If you hear that the equity markets are up or down, typically, with most of our client base, you are not 100% invested in the market. For those clients that are more invested in the market, it is for a reason. It's because you are tolerant of risk. So with the vast majority of clients, they do hold fixed income, and in most cases, that is weathering the storm quite well and providing very good income that can be reinvested. For some of our clients, they've looked at this as an opportunity to sell some of their fixed income and move into equities, and that's a case-by-case basis, and we can discuss that with you on a one-on-one basis. So what are our key takeaways? Listen, during times of uncertainty, and these are uncertain times, please, let's go back to the basics. Over the past number of years, we've been discussing with clients that this bull market is long in the tooth. And during our relationship with our clients, we will have a recession. And if we do have a recession, this will most likely not be our last recession. Recessions occur typically once every 5 years in the market. However, be mindful of moving to long-term instruments that offer little or no return for the investment that is warranted in them. And I mentioned the 30-year Treasury at this point. We do feel that it's very likely that stimulus will be added, but having said that, it takes some time for the stimulus to work into the economy. This is a global problem. The United States, and as an American, I have every confidence that we will throw everything at this issue that is humanly possible. But it is up to each and every individual to take responsibility for their own portfolio. No government official is going to fix your portfolio. That is really our job together to work on that. We do feel that the basics of the economy were sound prior to this downturn. We had historically low unemployment. Interest rates were even low. At that time, they've gone lower. So we feel that excellent opportunities to refinance. And for the young investor or for that individual with cash, what an opportunity. Consider your time horizon. How long are you investing your money? Is it for 1, 2, or 3 years? Typically, it is not. For most of our clients near retirement or in retirement, you are investing for the rest of your life. This is not a short-term scenario. You're pulling money gradually out of your portfolios, and this will work out over time. And again, the opportunities to present themselves, a few to take note of. Consider refinancing any debt that you have long-term that is much of a higher rate. If you're adding new money, it is a tremendous opportunity to do this. We're recommending that clients consider legging into this market at this juncture. It is difficult to predict when their down days will be. If you're making IRA contributions, consider making IRA contributions not just for the present year or the past year, but maybe for the future year. So if you're making an IRA contribution to finish up your taxes for 2019, certainly make it. You have to. But also consider making an IRA contribution for 2020. It's an excellent opportunity to do that. Again, most investors typically act for the long term. It's near impossible to predict, and certainly in this set of circumstances, the short-term movements in the market. It's, as the saying goes, it's like trying to catch a falling knife. Don't try to do it. We do have some other issues that we'll be dealing with this year. Certainly, the election was ordinarily going to add some level of uncertainty to the economy, and that is expected. If you see volatility occurring, it is a normal course of things, and we've discussed this with you during our quarterly meetings with you or semi-annual meetings. Be aware of geopolitical issues, and certainly one of the geopolitical issues that's occurring now is really the trade war that's really going on with both Russia and Saudi Arabia, essentially dumping oil onto the open market. That is driving oil prices down to historically low levels, and again, causing strain on some of the Midwest suppliers who are fracking and utilizing oil in that capacity. We all believe in American ingenuity, and this will force American oil producers to even be more efficient in their drawing capacity or drilling capacity than they are presently. I have every confidence that they will be, but it will take some time to work that out. What I wanted to say, and what we were going to do earlier this year when we were crafting this workshop presentation for our clients, one of the big issues that occurred last year when really no one was paying attention was the Secure Act. The Secure Act was passed late last year when everyone was cooking and baking shortbread cookies and finishing up their holiday shopping plans and preparing for family gatherings. The new legislation is profound, and as we say, it is a game changer and represents a really important element of our planning strategy with our clients. And it is important, despite all of the unsettledness in the financial markets, it is very important that you are informed about what the Secure Act is and how you can alter some of its impacts to you and to your loved ones. So let's talk about what the Secure Act is and what you need to know. The Secure Act is really an acronym. The Secure Act stands for the Setting Every Community Up for Retirement Enhancement, or Secure Act. And this was a bipartisan retirement bill that was included in a larger legislative package, and it was passed in late December of 2019. Let's talk about some of the highlights of the plan and the impact to our clients. First and foremost, it allows small companies to set up 401k plans on an easier basis. That's a positive. It also changes the required minimum distribution starting age from 70.5 to 72. Please note, for any clients or any individuals already receiving a required minimum distribution, it does not change it for you, but only for clients who will turn 72 or turn 70.5 this coming year. So your age is now extended to age 72. It also allows anyone with earned income the ability to contribute to an IRA after they reach retirement age. So even after 70.5, or for that matter, 72, as long as you're earning income, you could actively contribute to both a Roth IRA or a traditional IRA. This is not something that was able to be done prior. Prior to this, you could only contribute to a Roth IRA. The biggest thing that changes with this, and this is what we want to make note of, in most instances, it eliminates the stretch IRA. And that means that it mandates that inherited IRAs for most non-spouse beneficiaries, that means your kids or your grandchildren, must be withdrawn within 10 years. This is a huge deal and especially affects the middle to upper class of America. Most of our middle and upper middle class of America has a substantial portion of their retirement assets in qualified plans. What's a qualified plan? A 401k, an IRA. A 403b, a profit-sharing plan. A SEP IRA, a simple IRA. All of those plans are affected and impacted by this legislation. There are some exceptions to the 10-year rule, and those exceptions are for certain beneficiaries. Most certainly, the obvious one is your surviving spouse. The employee's children under the age of majority. So if you have a child and you passed away and that child is under the age of 18, then they're not required to take the distributions. However, upon reaching the age of 18, they must begin under the 10-year rule. If you have a beneficiary who is a non-spouse, who is disabled, they are also exempt. If they're chronically ill, they are also exempt. Some of the other strategies that we want to talk about are managing the income tax consequences of the 10-year rule. Again, let's discuss an example of what might happen. Let's just say my wife and I, Donna, have $1 million in an IRA and we have 2 children. And we both are driving down the road and we pass away. Each child will receive $500,000, and once they qualify for an exemption, they will be mandated to pull that money out within 10 years. Think about a couple of things here. That means that child will have to pull out that money, and it's not pro rata, by the way. That means that they don't have to take it out proportionally each year. But if they take it out, they'll be paying income taxes not only that are higher on their own income, but also on this distribution. Your child also has to become an investment person. They have to be skilled and knowledgeable about how to invest money in this type of environment. Think if they inherited it in an economy and an environment like this and they don't have an advisor. That is very much why we've been reaching out to all of our clients' beneficiaries and being very proactive so that we're informing them of who we are, what this legislation is, and we will follow up diligently on investment strategies, not just now, but for the future. So it's very important that you help us in this capacity. We want to preserve your estate, which I assume you do too. So there are some strategies that we'll discuss that we haven't discussed ever before with clients, and that one is family tax bracket management. Simply discussing who is in the higher tax bracket. Is it the parents or the child? Maybe you have a child that works for a high-tech company like a Google or an Apple, and they're in the management capacity of one of those companies, and they make a lot of money, and you have recently retired. Well, maybe converting to a Roth IRA in your bracket makes a lot more sense than that child inheriting that money. There's also other ways, if you are charitably minded, to set up charitable-based strategies, such as qualified charitable distributions or charitable remainder trusts, to simply accept these contributions, lower your tax rate, and satisfy your charitably minded interests. And also, just overall tax and wealth transfer planning, we want to discuss that with you. It's a good reminder to review your will and estate planning, and we'll discuss that with you. The Secure Act does bring into our purview, should I leave my traditional IRA to my child, or should we convert it? And simply stating some do's and don'ts. Generally, if you are the holder of the IRA, and as this seesaw type of diagram shows, if you're in the higher tax rate and your beneficiaries in the lower tax rate, then it probably does not make sense to convert to a Roth IRA. Why? Because the year in which you convert is when you pay the taxes. So we'd be giving the IRS more money. Most people aren't inclined to give the IRS more money, so we'd like to keep it to your heirs or to yourself for sure. But clearly, if you're in a lower tax break tax bracket and your child is in the higher tax bracket rate, then we might want to consider a partial or a full Roth conversion. Partially converting might mean doing it in stages so you don't upset your own tax bracket. And again, that requires coordination between us and your tax advisor. In many cases, we have a very strong relationship with your tax advisor, and we would recommend being part of that team and helping you through this. So proactively managing the income tax consequences of the 10-year rule is important, and we're going to work with you on that in our upcoming meetings. Everyone's situation needs to be considered, so it's not just the wealthy or the middle of the road type of wealth. Everyone needs to be considered. And again, we want to plan instead of predict. This is the law of the land today. We need to start to take steps to manage for that. So again, overall planning, let's discuss your goals, your time horizon, your risk tolerance, and your comfort level. We're going to work with you on your personal objectives, so it's important for you to reach out to us and talk with us, and we'll obviously be reaching out to you and are doing that already. Again, it's important to consider rebalancing your accounts at this time. Do we want to take some profits in the bond positions that we have and reallocate those towards equities at lower prices? Let's discuss your overall tax planning strategies. Do you have an adequate emergency fund? Are you going to fund your retirement accounts early this year to take advantage of lower equity prices? And we obviously monitor your portfolio regularly, and we're going to be doing that now and going forward. In addition, we want to try to maximize retirement plan contributions. For those still contributing to a 401k plan, you can contribute $26,000 this year if you're above the age of 50. What a great time to do that if you're even self-employed, to make contributions at this juncture in this type of economy. We are going to discuss also, as we always do, tax loss gain and harvesting strategies for our clients. And does it make sense to implement some tax-exempt strategies or tax-advantaged strategies, which we'll discuss with you on a one-on-one basis? Again, the key takeaways is we want to be vigilant in your situation. We want to focus on your own personal goals, not what the market or what the TV is telling us, and call us with any concerns. Again, we review changes for our clients regularly, and as you know, we are in constant communication with you. One of the reasons that we launched Solution-Driven Wealth this year is we wanted the communication process to be much different than we have been in past years. And as many of you know, we are communicating with you in a constant fashion, both with newsletters, with emails, with personal meetings. We are here for you, and we want to have frequent discussions to review your own situation and in many cases try to take advantage of situations as they present themselves. Our goal as your advisor is to maintain a non-emotional perspective and objective. We're not going to react and make emotionally based decisions. And we're going to make decisions that are in your best interest. We are a fiduciary, and it is our responsibility to do that. We are here for you and to serve you. For many of you, I know this is an uncertain time. We have worked with you. We are honored that you are our clients, and we care for you both on a professional and on a personal level. So I know this is an uncertain time, and I know some of you are fearful. I have every confidence that we will get through this and that we will persevere and that your portfolios will persevere. We've made good, sound decisions. We will go back to the basics when we discuss this with you one-on-one, and we are here for you. At this time, we're also understanding that many of your friends or coworkers or neighbors or family members are not getting information. They're reacting emotionally in this type of environment. And in my mind, in our professionals' minds, associates and colleagues, this is a recipe for disaster. Please help us help them. let us send them a newsletter. Just provide us their name and information. We will get them information. As I said at the outset, our goal is for you to be the most informed, best educated investor on your street, neighborhood, community, synagogue, or church. That is our goal. That is our mandate. And we look forward to helping not just you, but your friends going forward. I thank you for listening. And as we go forward, we'll be sure to communicate future information as it develops. Thank you and have a great day.